turns 21, that takes us into adulthood. And therefore, we have some of our mentors joining us to tell us how we take major economic debates forward. We have with us today someone who has, of course, been a CNBC-TV18 guest for all these 21 years, and someone who is the go-to man for the government and for the country on matters financial, banking and economy. I have with me Mr. K.V. Kamath, of course, formerly head of the New Development Bank, formerly chairman of ICICI Bank, and of course, so many other hats he wears. Mr. Kamath, thank you very much indeed for joining us on what's a very important week for us.
Thank you, Latha, and let me wish CNBC a very happy 21st birthday. It has been epochal. What you guys have done and built in India is something that we will all cheer all the time. And it has been great to be associated with the channel as somebody participating in the debates and going on, as it were, for all these years. And I wish you, the team, many more years of doing good on this platform.
Okay. Well, let me then start with an optimistic question, sir. The second quarter GDP numbers came in better than expected, in the sense we shrank less as an economy than the Reserve Bank itself had estimated. The Reserve Bank had estimated 8.6 contraction. We came in at 7.5. And since then, we've also seen some decent number of auto sales numbers coming in. What's your sense of the economy now? You have just looked at stressed assets very closely. You would have a better idea.
Yeah, let's look at it in two contexts. The early signs of improvement were visible in, I would say, starting late May. And then they accelerated during June, July, August, September, October. So they don't come as too much of a surprise. To me, I would have been surprised if numbers were not good up to, let us say, August or so, and then suddenly we saw an improvement. So this was a steady improvement, and I believe that gives it more credibility. That's the first point that I want to make. And I think provides a proper foundation for us to get on to the next phase in terms of recovering lost ground, as it were. Now, in terms of what you asked on the ground, what is happening, I'd say casual talk with bankers is the situation does not seem to be as bad as what we thought, just 2-3 months back. As bad probably is not a right word. It is probably fairly good compared to what we thought would have been the situation today. I would have expected by today, for example, a slew of companies applying for hand-holding through the various schemes that have been made available. And I now understand that that is not really so. Very few companies really reaching out. This, I think, puts in context two things. The cleanup that was done earlier, A. B, I would think the healthy state of the large corporates in the country and even the mid-sized corporates in the country, the helping hand given to the SMEs in the country, I think all these put together, and of course, the revival of demand, have pleasantly surprised us. I hope these pleasant surprises continue.
Okay. Did you take a look at the ECLGS scheme? They have, adopted your 26 stressed sectors, and after giving about 1.5 lakh crore of guaranteed credit to the MSMEs, now the government is looking at the 26 stressed sectors that you identified, and up to 500 crore companies are going to be given guaranteed credit. Your thoughts?
I think it's absolutely a topical move. In a sense, I must compliment the government for the series of steps that were taken right from the beginning. I mean it because these were very well-crafted steps, and this takes that same well-crafted approach forward in providing a helping hand in a situation where probably all that you need is an assurance. You don't even need the money to be put on the table. The assurance itself works. And I'm sure that we will see good results coming out of extension of the scheme.
Okay. Okay. Now, sir, since you have this BRICS Bank background as well, talking to international economists, I want to ask you whether this time appears like 2003 to you, where we didn't know it, but we were standing on the cusp of a multi-year growth. Crude prices at that time also had risen from about $10 in 2000 to about $30 in 2003, commodity prices that started rising. We were coming out of stressed assets. Is it looking similar at all? Can we believe we are on the cusp of something big, multi-year?
Yeah, there are a lot of similarities, Latha. One is, of course, the cleanup in the stressed assets. That took place at that point in time. There is another very important aspect, which at times we tend to forget. And that was, post the 2001 steps by the government, that is the finance ministry, you had a sharp drop in bond rates. Bond rates fell from around 11% to 5.5%. Mortgages, as a consequence, dropped from 14% to 7%, and so on. And of course, corporate lending came down from 15% to 8 to 9%. I think, when we look at numbers just now, with almost all, the entire yield curve is for the T-bill is below the policy rate. I think you have a situation which I don't think even it was so even in 2000. This is better than that. So you have then helping hand being given by the government. Policy, the interest rates truly moving down. In the last 2 years, we were trying to drive it down, but interest rates truly moving down. And my experience shows there is no better tonic than low interest rates to drive demand. Demand both at the consumer end and at the corporate end. So yes, to answer you explicitly, we are in the same situation as 2003 in the context of what we could see as a new drive, a new momentum to the economy.
Okay. No, actually, you're right that home loan rates, if you remember, at that time fell to about 7%. Today, they're even available at 6.9 and 6.8 in specific cases for specific borrowers. But the contra also is, the other end of that pendulum is also possible. Like we saw in 2010 or 2009, excessive liquidity. Today, CPs are yields are even below the reverse repo. Reverse repo is at 3.35, and there are some CPs that are available at 3%. T-bills, sir, are at 3%. Do you think we could now reach a level of slight recklessness in lending? Because banks have so much money, they have to pay savers at least 3%, and then you may start looking for yield and make mistakes.
See, there are two aspects here. One, you also need a reckless borrower. I think over the last 10 years or so, the borrower also has learned a lesson. The borrowers have gone through two cycles. They've gone through the 2003 boom, and thereafter again the 2010 post the global crisis, what happened. So my belief is that this time around the borrower will be a careful borrower. So at least I hope that he will be a careful borrower, and we should not have that problem. More importantly, we have a very interesting situation that there's a large part of consumer credit also happening. And the consumer credit, the borrower there, I think is even more conscious. He now knows that there's something called a CIBIL score, which could impact whatever he does. 2009, he didn't have that in full extent. In 2003, of course, that wasn't there. So one part of the economy which you could have faced problems, the new part, that is the retail consumer, I think is today also is an informed consumer. So I think between the corporate borrower and the retail borrower, I think the propensity to borrow recklessly has dramatically gone down over the years.
Okay. No, that certainly is a point, sir. We are all worried about our CIBIL scores, and that can be the seminal difference between then and now. Let me come to the other issue, which is absolutely dominating mind space now, the RBI's internal working group, making recommendations that two very big ones that have captured the imagination of the economy. One, that corporates be given, conglomerates also be given bank licenses, and that NBFCs, even if they belong to conglomerates, be converted into a banking license. First, let me come to the corporates thing. Are you in the camp that says yes? You were quoted as saying yes.
No, I'm in no camp, and I want to explain where I am very clearly.
Okay.
Let me put it in context. This paper needs to be looked at in a holistic manner. This is a very well-crafted paper, and I believe a lot of thought has gone into drafting this paper. So we need to give or do justice to all aspects. It won't take time. So, and I would agree with every single thing that has been said there. But to me, of prime importance is the structure that they're talking of, the holding company structure, paramount importance in this context if we have to ring fence banks, and that is being articulated. The conditions there also have been very well set out, that there has to be neutrality before we get to that stage. Just as an aside, this was a desired state I had hoped for about 20 years back and didn't happen. Because that would have been the ideal structure under which we could have transformed ourselves, from a development bank to a bank. But it's, I think, right time that it is done. The promoter holding issue, I think, is again well addressed. Then move on to the NBFC issue. Here, I think, comes the interesting aspect, as I see, in terms of what needs to be done and what could be done. We need to first put in context systemic risk. As enterprises get, and I'm not talking of any of these NBFCs who are the large ones today. I'm talking of in general. As institutions get larger, systemic risk that they pose increases. And I think it's right for the regulator to say, I then need to understand what are the checks and balances that are in place, how do we make sure they work, and under what situation and under what condition would we as a regulator be most comfortable in addressing these institutions. And in their judgment, at this point in time, they feel that NBFCs are best governed as banks. I think we should salute the decision, because they are looking at it from a larger context. So I would think that whatever they are doing should be looked at and given very high importance. Now, very interestingly, they also caveated in every aspect that they need to tighten their own capabilities or strengthen their own capabilities and probably bring in technology into this. So there again, they're very clear as to what is required to be done as these steps are taken. I think that leads me to the last point that you made, that is the entry of corporates. Now, I want to put it in context. Again, if you look at our banking exposure percentage of GDP, we are amongst the lowest in the developing world, particularly when we compare to a comparable size or an economy which has gone through a transition, which was in terms of population our size, namely China, where the ratio of banking assets to GDP is about 170%, and it's 70% in our case. So we are talking of a 2.5x in terms of size. Now, the way I look at it, you then juxtapose that we are aspiring to be a 10 trillion economy, and we certainly are justified in aspiring to be a 10 trillion economy in 10 years. Typically we're talking of 5 trillion in 5 years. I'm talking of 10 trillion in 10 years. If we have to do that, I think unless we are able to get the size of the banking system significantly larger than what it is today, I think we will fall short in our ability to fund this growth. Of course, this growth may depend on other fund flows also, which at this point in time we won't talk about it. But you need a very strong domestic banking system and a very strong domestic market, the capital market, to provide for this growth. So you need to get the size of the banks up, but there is a risk as to how far the extent banks can grow, because banks growing very fast also causes systemic risk. I'm sure this has also been calibrated by the regulator. Then I think if you want, when I saw the note in detail, they have very clearly mentioned that there are certain constraints. The constraint is that, in terms of operating efficiencies, the private sector banks are better, but the private sector banks are smaller than the public sector banks. In terms of capital, the ratios are better in the private sector. They also make the point that in terms of capital efficiency and the ability to raise capital, the private sector banks have performed better. So they are basically painting the picture that there could be certain challenges in the current construct, and we need to accelerate those banks, a system which can provide this 10-year support that we need. And I think thereafter they're going down to say that in that context, when things are right, that again they're caveated by saying we need to have better regulatory systems, better supervisory systems, and once that is done, we need to look at how we could expand the players in this sector, meaning entry to corporates. I think this is a very logical analysis,
Okay.
and we should respect that analysis that has been done.
Okay.
I will end by saying, Latha, that 10 years back, a lot of the tools that we would need to do what they are saying might not have been available. Even 5 years back, you know that we did not have a single unified view of a borrower across banks. That is now available. Now, I would think that today, if you can in real time, get your credit score from CIBIL, and the CIBIL is tracking in real time your history, as it were, equally the large borrowers, who they are, what are they borrowing, for what purpose, where is the money moving, all is trackable. It's today's technology. I'm not
Mr. Kamath, okay, Mr. Kamath, you have bought into the internal working group's recommendations. We need to take a break here. We're coming back and asking other questions on what problems may erupt if corporates were given bank licenses. The conversation with Mr. Kamath in a minute. Welcome back to this special chat we are having with Mr. K.V. Kamath, the doyen of India's financial sector. Well, Mr. Kamath, before we went to the break, you gave us good reasons why you believe in the internal working group of the Reserve Bank recommending that conglomerates be given bank licenses. But let me tell you, one former RBI governor, 3 former deputy governors and 2 former chief economic advisors, 1 former chairman of the Finance Commission have argued against it, saying that there is every danger of connected lending. And the recent records in Lakshmi Vilas Bank or in Yes Bank are indicating that connected lending very much is there. Would you still want bank licenses to be given to conglomerates?
You again are looking at the past. I'm looking at the future. I'm saying that technology is available today. The Reserve Bank is very clearly saying that there are preconditions to, they're even going forward. The precondition is that they're to strengthen their own abilities in this regard. All I'm saying is that you today have not only the abilities in terms of what a typical you do as a regulator, you have abilities in terms of technology. All you have to do is make sure that that is in place. And I'm sure the intent is that those will be in place before they open up. Because without that, I would agree. I have no arguments against what you said. If we don't do that, then those arguments that you put forth will be valid. Okay. I'm saying that those tools are available today. Those tools can be put into play today. But just to counter what you said, 5 years back those tools didn't exist. Even 3 years back they didn't exist.
Okay.
There is the rate at which technology is changing, giving you real-time track of what is happening and where it is going. I think we are talking of a different world from where we were 3 years back.
All right.
And I'm sure
my worry. My worry and the worry.
Reserve Bank is scaling up its own abilities to make sure that these things don't happen. Okay.
Yeah. Well, if it is conditional upon that ability coming up, then
yes.
Yes.
So
perhaps,
clearly, yes.
Yeah. Let us.
So, yes. You said I was in a camp.
Yeah.
I want to conclude by saying I am in the camp that would like to see India be a 10 trillion economy.
Okay.
I'm in a camp that would like to see India
that was my next
appropriate access to capital.
Yeah, that is
but
what.
I'm not in a camp that we do things in a rash manner.
Okay.
So this step has to be sequenced once what Reserve Bank itself has caveated for itself is in place.
Okay. Well, now I want to come to exactly that point that you raised, that, you want to see India in a 10 trillion camp and the banking sector, banking assets are only 70% of GDP. Let me take you back to what you told me, sir, 20 years ago when you headed ICICI Bank. You said, I used to worry that India needs, at that time it was a big number, 1 lakh crore of infrastructure. Where will that money come? And then you said in 2003, when there is a bankable asset, money comes. That is what I realized. These are your words I'm quoting. So why are we treading the path which is full of dangers when, as you say, bankable projects will create, loans create their own deposits, animal spirits create their own credit?
You need the underlying institutions which have the size and the capability.
We have ICICI, sir.
What I'm saying is that we are now getting into size, which is a multiple of where we were.
Okay.
And clearly, if we do even back of the envelope calculations of the size of the banking system and the capital market, it is not able to shoulder this burden. And that is why the regulator says, and I agree, that we need to scale and scope this up so that we do not create a stumbling block in our path to this 10 trillion.
Okay. Point taken, sir. Where it comes from you, it's very important. You have seen India through 4 decades of growth.
Latha, if I can move on this subject itself of 10 trillion for a moment.
Yes.
See, 10 trillion construct is going to be slightly different from the construct that we saw in early 2000 or even 2010 or post-2010. Yes, all those things will be the drivers. But I would think the key driver, and I will put now a number which is, in a way, it looks like out of my hat, but I would think 40% of the future growth will come from areas which we still have not, I would say, fully explored. And that is the digital super cycle. I think the digital super cycle is going to provide the brunt of the future growth that we will see. And that is, again, very interestingly, jumping on it at the right time.
Okay.
We have had no need to experiment with it, and we can jump on it at the right time. We have the foundations for it ready today. And we have the entrepreneurial mindset for it today. We have the technology capabilities for it today.
Okay.
So I would think we will see a very interesting path to this development. Here is a other interesting thing in this path to growth. Here, most of the capital is equity.
Yes.
And it comes from a myriad sources. A lot of it could be from abroad. So we would see very interesting ways in which businesses will be built between now and 5 years. And I'm sure if we were to take stock 5 years hence, we will have a completely different chat on how growth has happened and what lessons this has given us.
Okay.
I don't know whether you have been tracking this company called Pinduoduo in China, which is basically getting the farm to the home, as it were, disintermediating the entire system in the middle. And what are they? They're basically a platform. And so that we put it in context, the market cap as of yesterday was nudging $200 billion. This is a company we started off 4 years back. And basically, in terms of the future, these sort of enterprises have been made the focus going forward in that country. Why is that? Because then you are basically retaining I would say, the wealth generation at the farm level, retaining the jobs at the farm level, and creating a logistics and supply chain which reaches the market and gives the farmer high levels of efficiency, reducing wastage, dropping transportation costs, and of course, giving him a better price realization. So all sorts of things are happening. And I was just thinking to myself, if a Pinduoduo can work there, it can easily work here, meaning our own homegrown equivalent of this. I pick only one type of business, just as an example. There will be myriads of businesses which will contribute to what I call the 40% of the 10 trillion that is yet to happen.
Okay. Thank you very much, Mr. Kamath. On our 21st birthday, you have told us that India's startups, India's digital talent will be able to catapult us into a $10 trillion economy. So 5 years from now, we will have a very different conversation. I do hope you are right. You are a perma bull, and you have been right on many accounts on this issue.
All good wishes, Latha, and many more years of great success ahead.
Thank you very much, Mr. Kamath. Okay, so that's a very optimistic conversation, a very optimistic Mr. Kamath saying that if we were able to leverage digital, then we can catapult ourselves pretty quickly into a $10 trillion economy. And he believes that you can give corporates licenses, but he wants a precondition that RBI be technologically equipped to find out connected lending and find out who is bankable and not. With that, we wrap up this special show. Thanks so much for watching. There's lots lined up for you.